Hi guys. Today we will analyze Anthem stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been an average performer in the overall market. Also recent evolutions are not positive. The long-term trend is still positive, but the short-term trend is negative. It is advised to wait a little bit longer to see how this turns out. Strong support levels are around $444 and $405. Next strong support levels are around $365 and $340. Strong resistance levels are around $470 and $500. Next strong resistance level is around $520. In the last month the stock has been trading between $444 and $521.50 range, which is wide. It is currently trading near the lows of this range. The stock has an average volume of 1.1 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth. Even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model. Discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 10% per year, for last 5 years. We see that the average profit margin of the stock has been around 4% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 118% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Anthem Company: bad, average, and good. First scenario. Anthem will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be a low, 4%. Future profit margin would be a low, 4%. Future free cash flow to net income rate would be a low, 80%. In this case, the fair value of the stock today would be $265. Second scenario. Anthem will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 6%. Future profit margin would be average, 4%. Future free cash flow to net income rate would be average, 90%. In this case, the fair value of the stock today would be $320. Third scenario. Anthem will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 8%. Future profit margin would be high, 4%. Future free cash flow to net income rate would be high, 100%. In this case, the fair value of the stock today would be $383. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 25.4. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Anthem, analysts forecast growth rate around 8% per year in next 5 years, and future P/E around 16. Again, I will use 3 different scenarios for Anthem Company: bad, average, and good. First scenario. Anthem will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be a low, 4%. Future P/E would be a low, 14. In this case, the fair value of the stock today would be $215. Second scenario. Anthem will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 6%. Future PE would be average, 16. In this case, the fair value of the stock today would be $291. Third scenario. Anthem will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 8%. Future PE would be high, 18. In this case, the fair value of the stock today would be $388. As you can see, today the stock is overvalued, $444, even if we expect the company's high performance in future. The fundamentals are decent, but the stock is expected to show a small growth in revenue in the next 5 years, 6 to 8% yearly. Based on that, the stock looks a bit overpriced at the moment. I may consider buying the stock when the stock drops below $350–370. Company strengths. Anthem is a leading provider of health insurance in the U.S. It is the largest for-profit managed healthcare company in the Blue Cross Blue Shield Association. The company has approximately 40 million members. Prior to 2014, the company was named WellPoint. This well-managed company provides affiliated health and specialty insurance plans for government and commercial clients. Anthem continues to benefit from rising enrollments in its government segment, rate increases and the expansion of its in-house pharmacy benefit manager, IngenioRx. The recent resolution of the firm's long-standing contract dispute with Express Scripts, and subsequent creation of the IngenioRx platform should support material savings for clients, higher profitability for Anthem, and the potential to boost growth with cross-selling opportunities. The company's profit margin of 4% and return on assets of 6% are amongst the best returns of the industry. Its return on equity of 17% is comparable to the industry average. Risks. The company must accurately predict healthcare costs in order to set appropriate premiums. Its business could also be impacted by changes in funding for Medicare and Medicaid programs, and by other factors that could reduce enrollment. The insurance and pharmacy benefit management industries will likely remain targets of regulators aiming to reduce the healthcare cost burden on society, which is its key environmental, social and governance risk. In addition, Anthem faces a range of compliance and legal risks, including ongoing lawsuits. The COVID-19 transition from pandemic to endemic creates a variety of risks for insurers like Anthem, probably most importantly around its employer-based insurance roles, medical utilization, and plan pricing risks. Intense competition for health plan contracts, and unexpected sharp increases in medical cost trends. The bulk of insurance membership growth in the long run may stem from lower-margin government-sponsored plans, creating a structural headwind to insurer profitability. Based on estimates for the next 5 years, the company will show a small growth in revenue. The revenue will grow by 6 to 8% on average per year. The earnings per share is expected to grow by 12% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.